Amazon reported quarterly financial results that are sending the stock price down following this earnings release. So, I wanted to share with you the details, the financial statements, the good and the bad from Amazon's latest release. I'm going to go with you step by step, highlighting certain key figures from the financial statements. Now, I know financial statements can be intimidating for non professionals, so I'm going to go through these financial statements in a very simplified way to break things down and make them really simple for every step of the investor process. You don't have to be a professional to be able to follow along with what I'm going to share with you here.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Okay, so the first thing I'm going to share with you is from Amazon's cash flow statement. So every company has three primary financial statements. Those are the income statement, the balance sheet, and the statement of cash flows. What I'm going to look at here is the statement of cash flow, and it describes exactly what it sounds like, the movement of cash, and it breaks down three categories: the cash flows from operations, the cash flows from investing activities, and the cash flows from financing activities. As an investor, what you want to see is a company generating cash flow from operations. Cash flow from investing and financing is less sustainable. Just like if you think of your personal finances, right? You can generate money by earning it, working, or generating income from your business. You can generate money by selling your assets, right? If you have a car, computer, phone, you can sell those things and raise cash. And then third, you can raise money by borrowing money. You can go to your credit card, you could go to your bank, and you can borrow money. Out of those three sources, the best way to get money, right, is to earn it or generate those profits from your business, because selling your assets to raise cash, that's no fun. You're losing things in order to gain money, and that's not sustainable. Eventually, you'll run out of things. And then borrowing money is not sustainable, and that comes at a cost. You don't want to generate capital that way. That's only for certain situations, right? So a business is the same way. And I'm going to share with you a breakdown of Amazon's cash flow from operations. And what you see going from left to right is its cash flow from operations over the most recently completed 3-month period, the most recently completed 6-month period, and the most recently completed 12-month period. That's why the numbers get much larger as you move to the right, because they're incorporating more time in operations. So its cash flow from operations in the recently completed 3-month period increased to 32.5 billion, and that was up from 25.3 billion in the same time last year. So cash flow from operations very strong in the most recent quarter, and a solid improvement from the same time last year. Similarly, in the most recent 6 months, cash flow from operations increased to 49.5 billion, up from 44. And in the most recent 12-month period, cash flow from operations improved to a whopping $121 billion Amazon generated from its business operations, up from 108 billion the same time last year. Now, what you see below is investing activities. And so this is cash flow from investing. And I mentioned you don't want a company generating its capital from this source, but you do want the company to be investing money into this category, especially if the company has demonstrated effectiveness in doing this. So some companies that I like to give credit to a lot of times is Amazon, and another one is Netflix. They've been two of the few companies, well, I shouldn't say few, there's a lot of companies that do this, um, that effectively spend their capital, right? Netflix is great at using their money to make content that people love, and Amazon is great at using its money to build services that people love. Their website, the reason people love to shop on Amazon's website primarily is because of how easy it is and convenient it is to shop on that platform. And there's been a lot of investment that goes into making that website so convenient. And it's the back office, it's the logistics, it's the fulfillment that makes shopping on Amazon so convenient. Amazon has been similarly as effective in spending its capital in developing artificial intelligence capabilities. Many businesses, in fact, including Netflix, use Amazon's cloud computing for the computing power needed, right? Netflix uses computing to stream that content to you over the air, over the internet, and Amazon hosts Netflix's computing power, and it's built a very effective network, a very effective cloud computing network. That's the primary category Amazon has been spending most of its capital into. And in the most recently completed 12-month period, Amazon spent a whopping $108 billion in this category out of the $121 billion they generated. So even after spending $108 billion boosting its business, it still had over $13 billion left over. That's a sign of a very healthy business. And when you've demonstrated such effectiveness in spending this capital, investors should be happy to see Amazon spending this money. So if this was another company that was not as good at investing this capital, I wouldn't want to see them spending money, right? Example I like to give of the opposite is AMC Theaters. AMC Theaters over the previous 2 decades hasn't really improved the business by all that much, right? All they've really done is make the popcorn, instead of buying popcorn at $4, you're now paying $9. Soda is $7. What have they done to improve the movie-going experience? Not that much, right? And so people have increasingly stopped going to the movie theaters and started watching content at home and streaming content more often. I don't want to see AMC theaters spending more money, putting more money back into that business. They've demonstrated that they can't invest that money in a way that brings customers back, right? We've seen that over a decade. They just can't find a way to bring customers back. And so I don't want to see them spend more money into that business. I want to see them harvest their existing assets and return capital to shareholders if there's anything left over, which there isn't because they're losing so much money on the bottom line. So that's the opposite of Amazon. With Amazon, I like to see them spending money in this category. So the next statement I want to share with you is the balance sheet. And in the balance sheet, a company reveals its assets and liabilities. And you do want to see their cash balance and their liabilities, and you want to see the health of the business. But that analysis, looking at the cash and the debt, the difference between those two, or the net cash balance, is usually most important for companies that are in financial trouble. Companies like AMC Theaters that I mentioned earlier. They have, last time I checked, it's been a while since I have reviewed that company. Last time I checked, they had over $5 billion in debt, and this is very high interest debt, and the business was generating negative cash flow. So they're in trouble, and you like to evaluate their balance sheet to look for, how much time do they have left before they run out of cash, right? That's not the case with Amazon. So when you're evaluating Amazon's balance sheet, you're looking for something different than if you're evaluating the balance sheet of a company like AMC Theaters. Okay, Amazon, very healthy company. We just saw the company generated over $100 billion in cash flow. And, no worries here about the solvency of Amazon. So you don't even need to worry about that. What I look for in Amazon's balance sheet, or what I would look for as an investor in Amazon's balance sheet, or any company like Amazon, is something like property and equipment. This is the category they've been spending a lot of their capital into. And I want to see this number rising for the reasons I mentioned earlier. If Amazon generates, right, every business generates a return on their assets. That's the only way a business generates profits, is based on their assets. Every business has different assets. Some businesses are based on intellectual property, like Disney. Some businesses are based on physical property, like Amazon. Amazon is a mix of physical and intellectual property. More recently, their physical property is what's getting a lot of the attention. And Amazon, since they're so large and since their investments can be quantified and they're so tangible, I like to look at their balance here, property and equipment. Where is it trending towards? And I like to see that between December and June, their property and equipment net of depreciation increased from 252 billion up to 297 billion, or 298 billion from 253 billion, an increase of about 43, 44, 45. I forgot how to do math. $45 billion here in the previous 6 months. And if they continue increasing these assets, and at the same time, which Amazon has demonstrated, they're increasing the return on assets. As an investor, you like to see that because they're demonstrating to you that they can generate a good profit on the assets, and they're demonstrating to you that they can push the ceiling. They don't hit a ceiling with the assets. A lot of businesses are not scalable, and that's a big concern, especially for growth stocks, is they hit a ceiling. They're not scalable. They can't continue to expand beyond a certain point. And that was a concern with Amazon maybe, a few years ago. But they've demonstrated that they can continue expanding and still generating good returns on assets. So I like to see this number here in the balance sheet. I think this is one of the most important numbers on Amazon's balance sheet because of the factors I mentioned earlier. Now, as I mentioned, you need to look at this on a case by case basis. And over time, you'll learn what numbers are most important for which companies. And it helps to watch someone like myself with the background, with the financial education. I have a master's degree in financial economics. I passed all three levels of the Chartered Financial Analyst exam. I've been evaluating financial statements for 7, 8, 9 years now. So I have experience with this, and I can share those details with you, and you can learn from how to evaluate a company's financial statements and learn what's important for what company in what type of situations and what to look for and what to emphasize in certain situations. So I hope this has been helpful. If it has been, please comment in the comment in the comment section below, and I'll make more videos just like this one. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.